Welcome to the Auditor General's webinar, Expenditure Limitation Reports, the Basics. The objective of this webinar is to provide a basic understanding of the purpose and requirements of the expenditure limitation reports that are submitted to our office by all counties, cities, towns, and community college districts. We will start off by providing you with some background information about how and why expenditure limitations were first created and our office's role in implementing these limitations through the Uniform Expenditure Reporting System. Finally, we will describe the purpose of the Expenditure Limitation Report, as well as provide an overview of the information that is to be included on each page of the ELR. Now for some Arizona legislative history. During the late 1960s and 1970s, many states began experiencing dramatic increases in assessed property valuations, and as a result, property taxes rose rapidly. Unfortunately, personal incomes did not rise at the same rate, making property tax bills increasingly hard to pay. Arizona legislators watched as other states made attempts to bring this problem under control. One attempt in California was to place a limit on the amount property taxes could be increased for an existing property owner. While this was beneficial to taxpayers, it limited the future growth of local revenues for governmental entities in the state. Arizona legislators did not want to limit growth in the same way. In an attempt to stop these same issues from happening in our state, Arizona voters passed Proposition 101 in November 1978. This proposition added Section 17 to Article 9 of the Arizona Constitution, limiting state spending to 7% of the personal income of all state residents. It also established the Economic Estimates Commission, or EEC, and gave the Commission the responsibility to determine and publish each year the estimated total personal income for all residents to be used in computing the appropriations limit for the legislature. While this took care of the problem at the state level, local government spending was still growing at a rapid rate. Ultimately, the legislature determined that spending limitations at the local level needed to be established as well.
On the June 1980 ballot, an amendment to Article 9 of the Arizona Constitution was put to a vote and passed. The amendment added Sections 20 and 21 to Article 9, imposing expenditure limitations on counties, cities, towns, and community college districts. These expenditure limitations were intended to limit the spending of local revenues. The spending limitations were to be established using a base year's expenditures and allowing for increases in spending each year thereafter based on a factor related to inflation and population growth, or student population for community colleges. Legislation may also impact expenditure limitations. However, this type of adjustment is very limited. The base year chosen for the purpose of calculating local spending limitations was fiscal year 1979-80. This year was chosen because it was the most recent data available at the time the local spending limitations were proposed. Because the bulk of expenditures for that year had already been made, the expenditures could not be intentionally or artificially inflated. The EEC was given the responsibility of calculating the base year expenditure limitations for each political subdivision and for determining the expenditure limitations for each fiscal year thereafter. The EEC must provide each political subdivision subject to the UERS with an estimated expenditure limitation by February 1st and a final expenditure limitation by April 1st of each year. The EEC also issues revised final expenditure limitations for municipalities with annexations around June. The expenditure limitations issued by the EEC apply to the political subdivision for the following fiscal year. Here are the EEC's standard calculations for fiscal year 2011. The EEC starts by determining a population factor for each entity. For counties, cities, and towns, the EEC uses the most current population estimates available from the state's Population Statistics Unit, which is 2 years before the year to which the limitation applies, in this case, 2009. For colleges, the population is an estimate of the following year's full-time student equivalent supplied by the community college business officials. The inflation factor is calculated using the most current factor available, which is for the previous calendar year. Again, 2009 is used to calculate the 2011 limit. The population and inflation factors are then multiplied with the 1979-80 base limit to arrive at the following year's expenditure limitation. The legislature allowed some options to the EEC's spending limit calculation. Article 9, Section 20 of the Constitution allows counties, cities, and towns to permanently adjust their 1979-80 base limit used to calculate the expenditure limit, and allows cities and towns to establish an alternative expenditure limitation. In addition, ARS 15-1471 allows community college districts to establish modified expenditure limitations. All of these options are subject to voter approval. More detailed information on these alternatives are available on our website in the UERS manual. There are also recorded webinars available for viewing on our website that discuss permanent base adjustments and alternative expenditure limitations, also known as home rules. Once the amendment was passed, adding Sections 20 and 21 to Article 9 of the Constitution, the legislature had to decide how to implement the local spending limitations. In the next legislative session, ARS 41-1279-07 was established a uniform expenditure reporting system for all political subdivisions subject to the constitutional expenditure limitations. It requires those entities to submit annual expenditure limitation reports and financial statements to our office, and we review those reports to determine whether the expenditure limitations have been adhered to. Our office was given the responsibility of developing and implementing the Uniform Expenditure Reporting System, and to accomplish this, we developed the UERS Manual, which provides detailed instructions for completing and submitting the ELRs. For those of you that don't already have a copy, that manual is available on our office's website.
So you may be thinking, we already prepare financial statements. What is the purpose of preparing an expenditure limitation report as well? The expenditure limitations created by the Constitution are intended to limit the spending of local revenues only. For most political subdivisions, local revenues would include property taxes, sales taxes, and similar revenues. For colleges, local revenues also include state funds for student enrollment. The constitutional expenditure limitation is not intended to restrict an entity's ability to obtain and expend revenues from non-local sources such as federal grants. For that reason, non-local revenues are known as excludable revenues in UERS terms. Because financial statements are prepared based on a set of financial reporting standards known as the Generally Accepted Accounting Principles, or GAAP, what is considered an expenditure in the financial statements under the GAAP basis of accounting is not always subject to the expenditure limitation under the basis of accounting prescribed by the UERS and vice versa. So the purpose of the ELR is to take an entity's expenditures and other financing uses reported in their financial statements and convert them to expenditures subject to their constitutional expenditure limitation. The UERS manual provides instructions and sample forms for counties, cities, towns, and colleges to use in preparing their ELRs. The forms for colleges differ from those for counties, cities, and towns because colleges are covered by a different section of the Constitution. For colleges, it is their budget expenditures that are subject to the expenditure limitation rather than actual. Here is an outline of the structure of an ELR for a county, city, or town. As you can see, the ELR is divided into three parts, Part 1, Part 2, and the reconciliation, which are listed in the opposite order on the screen because the information in the ELR flows first from the reconciliation to Part 2 and finally to Part 1. For colleges, we eliminate the reconciliation and deal only with Parts 1 and 2, again with information flowing forward from Part 2 to Part 1. Each part of the ELR has a different purpose, and therefore different information plays a part in each. Throughout the process, we deal with financial statement expenditures and expenses, or budgeted expenditures for colleges, but we also use three other components to adjust those financial statement amounts and arrive at the expenditures subject to the constitutional spending limitation. Those components are called subtractions, additions, and exclusions. We will start with the reconciliation. As we stated earlier, not every expense reported in the financial statements is subject to the expenditure limitation. One reason for this is that some expenses in the financial statements are not expenditures as defined by the Constitution, and a few items that are not expenses under GAAP do meet the constitutional definition of expenditures. In the ELR reconciliation, we convert the financial statement expenditures to the UERS basis expenditures through subtractions and additions. Because college limitations are based on budget amounts, and these amounts already reflect a constitutional definition rather than a GAAP definition of expenditures, a reconciliation is not necessary for colleges. The starting point for preparing the ELR for a county, city, or town is the fund financial statements. The expenditures, expenses, deductions, and applicable other financing uses, special items, and extraordinary items reported within the fund financial statements are reported on line A of the reconciliation by fund category or type. These amounts include all operating and non-operating expenditures, but do not include transfers out. Next, we consider the items that, while recorded as expenditures in the financial statements, are not expenditures under the UERS basis. These items are listed on lines B1 through B4 for cities and towns, and B1 through B7 for counties as subtractions from the financial statement amounts reported on line A. Examples of these subtractions include expenditures that don't require the use of an entity's working capital, such as depreciation expense reported in an enterprise, internal service, or fiduciary fund, or expenditures of separate legal entities. After adjusting for items that don't need to be included in the UERS basis expenditures, we need to consider some items that are not reported in the financial statements as an expenditure, but should be considered an expense on a UERS basis. If financial resources were used for something that did not result in an expense in the fund financial statements, no amount was included in line A of the reconciliation, so an addition would be necessary to account for such items. Some additions that are required include principal payments on debt and acquisition costs for capital assets in the enterprise, internal service, and fiduciary funds. The additions are included on lines C1 through C4 of the reconciliation for counties, cities, and towns. The inclusion of these additions and subtractions completes the process of converting GAAP basis expenditures to UERS basis expenditures.
Now we will move on to the next step in the ELR process, Part 2. The resulting UERS basis expenditures that are calculated on the reconciliation are brought forward to line A of Part 2. For colleges, line A of Part 2 is the starting point for preparing the ELR, and the amount included on this line comes from their most recently adopted budget for the year. Earlier, we briefly mentioned that there are certain non-local revenues that are not subject to the expenditure limitation, which are referred to as excludable revenues. Part 2 of the ELR allows entities to exclude expenditures of these non-local revenues from their total expenditures that are subject to the limitation. However, determining when a revenue is excludable can be somewhat confusing. The same rules apply to counties, cities, towns, and colleges when determining the amounts of allowable exclusions. This is because even though the amount on line A of Part 2 comes from the budget for colleges, all exclusions are based on actual expenditures. The Constitution includes a very broad definition of local revenues. In fact, it considers all expenditures to be from local revenues except those specifically listed as exceptions to the constitutional definition. Those exceptions are the exclusions that are listed on lines B1 through B13 on Part 2 of the ELR. For example, expenditures from interest revenues or bond proceeds that are not considered to be from local revenues. Also, expenditures for principal payments on long-term debt, such as contract lease payments, and the related interest payments are excludable. So, only those exceptions that are specifically listed in the Constitution are allowed to be excluded from an entity's expenditure limitation. However, there is one situation in which the constitutionally defined exclusions are not allowed. If a city or town is under a voter-approved home rule expenditure limitation, the constitutional exclusions do not apply. However, These cities and towns do have the option to include some or all of the constitutional exclusions or other specific exclusions that are not related to those provided by the Constitution in the resolution adopting the alternative limitation. In that case, only the exclusions that are specifically defined in the resolution may be included on Part 2 of the ELR.
Constitutional exclusions may be revenue-driven or expenditure-driven. In other words, the excludability of an expenditure can be determined either by the source of the revenue that is used for the expenditure or by the nature of the expenditure itself. For example, since investment income is considered a non-local revenue under the Constitution, any expenditures from that income are not subject to the expenditure limitation. This is an example of a revenue-driven exclusion. On the other hand, debt service payments are excludable regardless of the revenue source used to pay them. So if an entity used property taxes to pay principal and interest payments on general obligation bonds, even though property taxes are normally a local revenue, when they are spent for debt service, they are not subject to the expenditure limitation. This is an example of an expenditure-driven exclusion. Calculating exclusions can be confusing, so we would like to take a moment to go over a few basic rules to remember when preparing Part 2 of the ELR. Although the revenue source determines excludability for revenue-driven exclusions, the expenditures of that revenue determine the amount of the exclusion. You can only exclude revenues that have been spent. So if an entity receives $100,000 in investment income in the current year, but only spends $50,000 of those proceeds in the same year, then the total allowable exclusion for investment income is $50,000. The remaining $50,000 may be carried forward to be spent in future years and will be excludable in the year in which it is spent. The previous example brings up the question of how to determine what revenues were spent when total revenues exceed total expenditures. That is where a revenue to expenditure flow assumption comes in. Something like the inventory valuation flow assumptions, FIFO and LIFO, but for determining what revenues are spent and in what order. The most common spending philosophy adopted by the UERS assumes that entities expend their local revenues first, thereby conserving unspent excludable revenues for future years. The term used most often here is to maximize carryforwards. So as illustrated here, an entity would be assumed to spend local revenues up to its expenditure limitation and then spend non-local excludable revenues as needed to meet its total desired expenditures for the fiscal year. Any excludable non-local revenues remaining unspent at the end of the fiscal year are carried forward in fund balance and are therefore expendable and excludable in future years. Alternatively, entities may take the opposite approach of spending non-local revenues first. Carryforwards could still be generated under this flow assumption if fund expenditures are less than total non-local revenues of the fund, but such carryforwards would be less than under the first assumption. There are certain revenues such as federal grants that must be spent within a certain time period. However, there are several others which may be carried forward in fund balance indefinitely. The flow assumption the entity uses should be applied consistently so that the character of fund balance is easily identified. Also, the entity cannot adopt one flow assumption for the financial statements and a different one for the ELR. For example, a county can't state in its financial statements, including the CFA, that it spent all of its payments in lieu of taxes received that year, and then state in the ELR that it did not spend them and is carrying those monies forward to future years.
Expenditure-driven exclusions are often easier to calculate because the amount of allowable exclusion is the amount of the expenditure or expense. For example, the exclusion for debt service on bonds is equal to the amount spent and reported in the financial statements for principal and interest on bonds and related escrow agent fees in the current year. Unlike revenue-driven exclusions, you cannot carry forward an exclusion that was expenditure-driven. That's because with these types of exclusions, there isn't anything to carry over to a future year. The expenditure that has been made, and regardless of if the entity needs the exclusion in the current year in order to stay under their limitation, the current year is the only time that the exclusion is available. In addition, if an entity used non-local revenue to pay expenditure-driven exclusions, such as debt service payments, it cannot exclude both the amount of the debt service payment and the amount of the non-local revenue paid. It can only exclude expenditures once. Those are just a few of the basic rules to remember when calculating exclusions. The UERS manual gives specific descriptions and examples of expenditures that may be excluded on each line of Part 2. Occasionally, we get requests for permission to exclude expenditures which fall outside the categories listed. Our office has no leeway to add or take away allowable exclusions. However, it is possible for several different revenue sources to qualify for an allowable exclusion category. If we get a question regarding revenue sources that we have never formally considered as to their excludability, and we determine that it does meet the definition of one of the constitutional exclusions, we will add it as an example in the manual. There are also times when the funding source for something changes, such as if the legislature changes the revenue source for a certain program, and the excludability changes as well. After all of the available exclusions have been included on Part 2, what's left is the total expenditures that are subject to the limitation. That number is then brought forward to Part 1. Part 1 is the last page of the ELR to fill out, and it is generally the least confusing. It reports the bottom line. Did the entity exceed the limitation or not? You start out with the entity's expenditure limitation. This is either the state-imposed limitation issued annually by the EEC or a voter-approved alternative limitation. In certain circumstances, entities are allowed to make adjustments to their total expenditures subject to the limitation before determining if they have spent within the limit. Part 1 for counties, cities, and towns includes adjustments for expenditures due to disasters and one-time overrides. Part 1 for colleges includes an adjustment for expenditures of workforce development monies received under ARS 15-1472. The expenditures subject to the limitation after any adjustments are then subtracted from the limitation amount to determine the total amount by which the entity spent under or in excess of the expenditure limitation.
In addition to the three main parts of the ELR, there is one all too often underappreciated part, the notes. The notes are important because they are used to explain why an amount reported on the reconciliation, Part 2, or Part 1 is appropriate when the amount cannot be directly tied to the audited financial statements. For example, if an exclusion is taken on Part 2 for grants and aid received from the federal government, but the same amount is not reported as revenue in the current year's financial statements, how does the ELR user know what the exclusion amount is correct? How can our office review the exclusion amount? The entity should include a note that describes the source of the excludable revenue and the reason the amount is not traceable to the financial statements. In this case, it may be that the entity received $2 million of intergovernmental revenue, and only a portion of that revenue received is being excluded as grants received from the federal government. The remainder was either a non-excludable revenue source or was not spent and carried forward to be excluded in future years. If that was described in a note to the ELR, it would allow the reader to clearly determine the source of the exclusion. One clear benefit of preparing notes to support amounts in the ELR is fewer questions from us, or possibly even avoiding a deficiency letter and a restatement of the ELR. Another benefit of preparing the notes is that in describing why an exclusion or subtraction is appropriate, you may identify an error such as an overstatement of the exclusion before the ELR is issued. So remember, every number in the reconciliation in Part 2 should be traceable to the financial statements. If an amount is not directly traceable, then a note must be provided to tie that number to one or more financial statement amounts. There are several resources available on our website to assist in completing expenditure limitation reports, including the UERS manual, UERS memorandums, FAQs, and other webinars. Those resources can be found under the Reports and Publications section of our website for counties, cities and towns, and community colleges as applicable. If you have additional UERS-related questions, you may contact us in the Accounting Services Division or email questions to asd@azauditor.gov. Thank you for viewing our webinar, and good luck in preparing your future expenditure limitation reports.